Hi there, converting a Milton Keynes property into an HMO? Let's explore which conversion costs may qualify for tax relief and which usually won't.
Picture this. You've just dropped £65,000 converting a standard family house in Milton Keynes into a fantastic, high-yielding 6-bedroom HMO. It looks incredible, the projected rental yields are brilliant. But here's a shocking fact. Miscategorizing just one single invoice on your tax return could accidentally trigger a full, exhaustive HMRC compliance check. Yeah, it happens to landlords way more often than you think. And getting it wrong, well, that could cost you thousands in lost tax reliefs, not to mention some pretty heavy penalties. Hello and welcome to This Explainer. I'm here representing Atlas Tax Advisors, or ATA for short. We're an expert UK accounting firm, and our whole mission is making property tax compliance clear, strictly legal, and entirely stress-free. Now, the rules we're unpacking today really impact anyone dealing in property, but we've designed this deep dive specifically for you, the UK landlord with maybe 1 to 3 rental properties who's actively looking to scale up that portfolio the right way. Over the next 10 minutes or so, think of this as your complete step-by-step guide to converting a Milton Keynes house into a house in multiple occupation, and exactly which of those hefty conversion costs are deductible for the 2026/27 tax year. Okay, let's dive straight into this. Here is our roadmap. 1. Planning and licensing fees. 2. Capital versus revenue costs. 3. The capital allowances exception. 4. Timing and finance rules. And finally, number 5, your HMO action plan. Right, Section 1, Planning and Licensing Fees. Let's talk about the rules specific to Milton Keynes. So unlike some areas in the UK where smaller HMOs fall neatly under permitted development, Milton Keynes operates completely differently. Back in December 2011, they introduced a borough-wide Article 4 direction to tightly control local housing supply. In practical terms, this means every single conversion from a standard C3 dwelling house, your typical family home, into a C4 HMO, which is a shared house with 3 to 6 unrelated individuals, requires formal planning permission. There are absolutely no shortcuts here. You can't just put up a few stud walls and start collecting rent. And to add to that, if your property has 5 or more occupants forming 2 or more households, you also face the extra hurdle of mandatory licensing. Now, before they ever hand over that license, the Milton Keynes Council enforces incredibly strict spatial and sanitary standards. We're talking heavy scrutiny on floor-to-ceiling heights, the precise number of double electrical sockets in a bedroom, and the ratios of washing facilities to tenants. This directly ties the physical, bricks-and-mortar conversion of your property straight into the strict legal requirements you have to meet to run your business legally. Basically, every extra sink, fire door, or electrical circuit you install is directly driven by the council's amenity standards. Which brings us to a very specific number, £730. That right there is the mandatory Milton Keynes HMO licensing fee for a standard application. When you're already trying to manage a tight $65,000 renovation budget, an admin fee like that can feel like a bit of an upfront shock. But rest assured, this fee is fundamentally just a cost of doing business. Because of that, it is fully deductible against your rental income as a revenue expense. Moving on to Section 2, Capital versus Revenue Costs. This is the crucial tax divide. So the crucial point is truly understanding this divide. It's paramount for any landlord. Capital expenditure fundamentally improves your asset beyond its original state. Think about adding brand new ensuite bathrooms where there weren't any, knocking down structural walls to change room layouts, or fitting those heavy-duty fire doors to meet the council regulations we just mentioned. These costs add to the property's base value, and they're locked away for capital gains tax relief, meaning you won't actually see that tax benefit until you eventually sell the house. Revenue expenditure, on the flip side, merely maintains the asset in its existing state. So repainting scuffed walls, fixing a minor roof leak, or paying for your annual gas safety check. These revenue costs are fantastic for landlords because they reduce your current year's income tax bill immediately, keeping vital cash inside your business today. Let's walk through our £65,000 Milton Keynes case study just to see how converting a £280,000 3-bedroom house actually breaks down in real pounds. Major structural work. Say, spending £32,000 for new stud walls, plumbing, and fire doors. That is definitively capital. But look at the HMO licensing fee. Even if it scales up to, say, £1,200 for a much larger property, that remains revenue. A thorough pre-letting deep clean for £800, also revenue, as long as it happens once the property business has officially started. Meanwhile, a £3,200 mortgage arrangement fee to secure your commercial borrowing, that is treated separately as a finance cost under Section 24, which means it needs its own specific handling on your tax return. Let's look at Section 3, the capital allowances exception. For a long time, HMRCs stubbornly viewed an HMO's shared living spaces as a single dwelling. This basically blocks capital allowance claims for landlords entirely, forcing them to treat almost all internal fixtures as locked-away capital costs. But then, enter the Tev Fick case. This was a landmark 2019 tax tribunal ruling that totally changed the landscape for property investors. Mr. Ted Fick successfully argued and proved that while the individual private bedrooms and the shared lounges are indeed dwellings, the communal transit areas in the house are not. Legally speaking, they are functionally exempt. Did you know this specific ruling actually allows you to claim the annual investment allowance, or AIA, on specific parts of your HMO? Now, you still can't claim on items inside the dwelling house, so your shared kitchens, bathrooms, lounges, and bedrooms remain completely off limits for these claims. However, the common parts, like your communal hallways, main staircases, and entrance vestibules, they do qualify. You can claim the AIA on qualifying plant and machinery. In a residential setup, plant and machinery means things like integrated fire alarm systems, specialized emergency lighting, or heavy-duty carpets located exclusively in those shared transit areas. It is an absolutely brilliant way to accelerate your tax relief. And here is a professional tip for you. Always, and I mean always, instruct your contractors to provide detailed, itemized invoices that separate your structural capital improvements from your routine revenue repairs. Seriously, do not accept a single line item that just says house renovation. Without a clearly split invoice, a busy HMRC officer reviewing your account is likely to just look at that massive composite invoice and default to treating the entire lump sum as non-deductible capital expenditure. You have to proactively protect your immediate tax deductions by demanding meticulous, itemized paperwork from your builders right from day one. Okay, Section 4, timing and finance rules. Let's cover Section 24 and mortgages. Listen, in tax, timing is absolutely everything. Let's say in month 1, you purchase the house and get the keys. Months 2 through 5 are entirely consumed by the dust, noise, and overall stress of your renovation period. Finally, in month 6, your very first tenant signs the tenancy agreement and moves their belongings in. Under strict HMRC rules, month 6 is the exact moment your property business officially commences. And thanks to the pre-trading expenditure rule, allowable revenue costs you incurred before this date, like your initial licensing application or that deep pre-letting clean, are legally treated as occurring on the exact day that first tenant moves in. This brilliantly allows you to legally claim those earlier costs in your very first operational tax year. Now, I do have to sound a stern warning about Section 24 mortgage restrictions because they absolutely apply to HMOs held in your personal name. Finance costs, like your hefty monthly mortgage interest payments, are no longer directly deductible from your rental income. Instead, individual landlords only receive a 20% basic rate tax credit. Because HMOs naturally generate much higher gross rental receipts than standard single lets, often doubling or tripling the gross income on paper, this inability to deduct interest before calculating profit can very easily inflate your taxable income. This trap frequently pushes well-meaning landlords right into a higher 40% or 45% tax bracket, which severely diminishes your actual take-home profit. Now, what's really interesting about this next bit is a hidden gem that could save you thousands of pounds: 5%. If you are converting a single dwelling into an HMO, the project can actually qualify for a reduced 5% VAT rate on contractor services, down from the standard 20%. Since most residential landlords aren't VAT registered and therefore can't reclaim it from HMRC, paying 5% instead of 20% on all that skilled labor and materials is an absolutely massive, immediate saving on your upfront build costs. You do, however, have to agree on this with your contractor before they issue the final invoices, so keep that in mind. Finally, Section 5, your HMO action plan. Let's pull this all together into a chronological checklist so you can ensure your Milton Keynes HMO conversion is completely tax compliant and financially optimized. Step 1, secure your MK planning and licensing early to avoid any operational delays or fines. Step 2, demand strictly itemized contractor invoices to robustly protect your revenue deductions. Step 3, map out and legally identify those common parts to maximize your annual investment allowance claims on plant and machinery. And Step 4, apply the pre-trading rules on day 1 of letting to properly capture all those early pre-letting revenue expenses. So I'll leave you with this final critical question. Are you leaving thousands of pounds on the table by miscategorizing your HMO conversion costs? The stakes of getting your tax categorization wrong are just too high. It's a dual threat. Not only do you suffer lost tax relief in the present, stifling your cash flow, but you also invite the very real, very expensive threat of HMRC penalties and interest down the line. Please remember, this explainer is for informational purposes only and does not constitute formal tax advice. Every property portfolio is completely unique. For personalized assistance with your property portfolio, please reach out to us at Atlas Tax Advisors directly. You can call us on +07 404 427 275, drop us an email at info@atlastax.co.uk, or visit our website at www.atlastax.co.uk. Thank you so much for joining me today, and please don't forget to subscribe to the ATA YouTube channel for more expert property tax insights. See you next time.